Hey Money Guy family, it's your host Brian Preston, Mr. Bo Hansen, back with another episode of Ask the Money Guy.
That's right. You guys have financial questions. We have financial answers. Go to your favorite social, use the hashtag AskTheMoneyGuy, or you can go to our website, moneyguy.com, or you can leave a comment in the comment section below.
It's Brian Preston, the Money Guy.
So Brian, today's question is one that we think is pretty basic, but I think sometimes we take for granted we get to do this stuff all the time. And this is the way the question goes. What is the difference between a stock and a bond?
Well, stock and bonds, these are some of the key fundamental building tools you're going to use for financial independence and just saving the money for the future. I called it the money. I'm in the age I use the for everything.
Money for the future.
So just like the Facebook, the Twitter. But in all seriousness, Bo, give them a definition. First tell them what is a bond and what is a stock, and then I'll kind of fill in what the difference is.
Yeah, exactly. I think in order to understand the differences, you have to understand exactly what each one of them are. I'll start with the stock first because that's maybe the one that's a little bit easier to understand. When you buy stock, you are actually purchasing ownership in a company. So when you buy one share of Apple or Home Depot or Google or Facebook stock, you're actually becoming an owner in that company. You have ownership in that. A bond is a little bit different. When you go buy a bond, you're actually a lender to that company. So when you buy a bond for an Apple or a Facebook or Home Depot, you're actually loaning money to that company. Well, in exchange for the loan you're giving them, they're going to say, hey, I'm going to pay you back a stated rate of interest called a coupon payment, and at the end of the term, I'm going to give you all your money back. So if you buy a bond for $10,000, I'm going to borrow $10,000 from you, I'm going to pay you a stated amount, and then in 5, 10, 15, 20 years, I'm going to pay you your $10,000 back.
That's exactly right. So let's talk about the difference and how you use these in your portfolio. First of all, bonds are considered safer.
That's right.
Because you are lending money to this company, and realize whether it's a government or it's a company, a private company, there are risks associated with them all, and there's actually rating agencies that will tell you how risky and how safe, and that you can buy the AAA,
That's right. Yep.
Secured bonds. You can buy junk bonds, which are B grades and so forth. So it's one of those things you need to understand. And from a safety perspective, if everything goes bad, bonds are definitely safer from a creditor standpoint, because if the company ends up going out of business, you at least have something that says, hey, as y'all are divvying up the assets, this thing's gone bad, this is I still am owed this, and you're at least in line for assets. If you are buying a stock, you're kind of left holding the bag if things go really bad. So definitely bonds are safer. And as you hit retirement age, you're going to like having that stability of income. Those coupon payments that Bo was talking about, that's going to kind of fill in the gaps for you to cover your own cash flows. You'll have those income streams coming in from the bond portfolio. Then when markets go down, you'll have something that's pretty stable that will help you get through that period of volatility with the stock market. Flip the script over to the stock market and buying stocks. As Bo explained, you are buying a little bit of ownership of the company, so it has tremendous upside, meaning if the company goes well, you get to participate in that. So, but the thing is that
with great reward also comes great risk.
Great risk. So it is exactly, bonds are safer, stocks are considered riskier, but they do give you more participation, because what's the best thing that happens with a bond? You get paid back and you get some interest.
That's right.
Best thing that happens with a stock is you hear those stories of somebody who invested $10,000 in Home Depot back in the 80s, and now it's worth $1 million.
Right.
Or the most recently was at Amazon, that if somebody would have put in, it would be worth $1.2 million.
Something silly like that.
Some crazy thing like that. It's always the stories of the stock, individual stocks, that allows you to do that. Now I will tell you, I don't want you buying individual stocks. We recommend on the show, we want you buying a diversified portfolio of stocks, and you can do that through mutual funds, ETFs, index funds. All those things will cover your basic needs.
You can actually do the same thing with bonds too. You don't have to go out there and figure out, okay, well, which company do I want to lend money to?
Or which government.
You can actually use ETFs and mutual funds for bond fixed income exposure as well.
So guys, these are great questions. I want you to understand these are the building blocks of your financial empire, is bond investing and stock investing. Obviously, when you're younger, you're going to have a lot more stocks. Pretty much 100% stocks when you're in your 20s, but as you get closer to retirement, that bond and stock exposure, you're going to get more and more bonds to kind of, limit that volatility and also create more income for you.
If you have a question or there's something in the financial world that you're curious about, feel free to reach out. You can go to your favorite social, use the hashtag #AskTheMoneyGuy. You can write us directly at moneyguy.com, or you can go to the comment section on any of our YouTube videos, leave a question right there, and we'll be happy to answer your questions right here in the Tesla.
Thanks for the questions. Keep them coming. Money Guy team out.